There's a piece of paper in your wallet that's accepted in every country on Earth. Not because it's backed by gold, not because it represents anything physical, but because 79 years ago, a group of men in a hotel in New Hampshire made a decision that would shape the entire global economy. And here's the strange part. It was supposed to be temporary. Today, about 90% of international transactions happen in dollars, not euros, not yen, not yuan. Dollars. If you're buying oil in Dubai, you pay in dollars. If you're trading coffee in Colombia, you pay in dollars. If you're a central bank in Japan trying to stabilize your currency, you buy dollars. The US dollar isn't just America's currency anymore. It's the operating system of global finance. And the story of how that happened is not the one most people know. Rewind to 1944. Europe is in ruins. Cities are rubble. Entire economies have been bombed into non-existence. The British Empire, which once controlled a quarter of the Earth's surface, is bankrupt. France is rebuilding from occupation. Germany is split and devastated. And the Soviet Union? Powerful militarily, but economically isolated. The global financial system that existed before World War II, centered around the British pound and the gold standard, had completely collapsed. Countries were hoarding gold, restricting trade, devaluing currencies in desperate attempts to gain advantage. It was economic warfare by another name. Meanwhile, across the Atlantic, the United States sat untouched. No bombs on American soil, factories running at full capacity. The country held about 2/3 of the world's monetary gold reserves. But here's what most people miss. America didn't want to dominate global finance, at least not at first. For most of its history, the U.S. had been skeptical of international entanglements, isolationist, focused inward. The idea of the dollar as a global currency would have seemed absurd to most Americans in the early 20th century. But World War II changed the calculation. Because someone had to rebuild. Someone had to create a system that prevented another global economic collapse. And someone had enough resources to actually make it work. By mid-1944, it was clear that someone would be America. The question was how. July 1944. 732 delegates from 44 Allied nations gathered at the Mount Washington Hotel in Bretton Woods, New Hampshire. Their mission, redesign the entire global monetary system. The conference lasted 3 weeks, but the real decisions were made by two men. John Maynard Keynes, representing Britain, arguably the most famous economist in the world at the time, and Harry Dexter White, representing the United States, less famous but backed by the only economy that still had money. Keynes proposed something ambitious, a global currency called the Bancor, issued by a world central bank that no single country would control. It was elegant, neutral, fair. The Americans said no. White had a different plan. The dollar would be fixed to gold at $35 per ounce. Every other currency would peg to the dollar at a fixed rate. The U.S. would guarantee convertibility, meaning anyone could exchange dollars for gold if they wanted. In theory, this was just a technical arrangement, a way to stabilize exchange rates and facilitate trade. In practice, it put the United States at the center of everything. Because under this system, if you wanted to trade internationally, you needed dollars. If you wanted to hold reserves, you held dollars. If you wanted stability, you pegged to the dollar. The British delegation knew exactly what was happening. Keynes himself reportedly called it a Faustian bargain. But Britain was broke. It had no leverage. The Americans had the gold and the money to rebuild Europe through the Marshall Plan. So the world agreed. And just like that, the dollar became the anchor of the global economy. But here's the irony. The system was built on a promise that the United States couldn't actually keep. For the first 25 years, Bretton Woods seemed to work. Europe rebuilt, Japan industrialized, global trade expanded faster than at any point in history. The dollar was as good as gold because the U.S. said so and everyone believed it. But there was a structural problem baked into the design. As global trade grew, the world needed more and more dollars to facilitate it. The only way to get those dollars was for the U.S. to run trade deficits, essentially sending dollars abroad in exchange for goods. But the more dollars circulated globally, the harder it became to maintain the promise that every dollar could be converted to gold at $35 per ounce. By the 1960s, the math wasn't adding up. The U.S. had printed far more dollars than it had gold to back them. Other countries, particularly France under Charles de Gaulle, started getting suspicious. They began exchanging their dollars for gold, draining U.S. reserves. De Gaulle understood what was happening. He accused the U.S. of having an exorbitant privilege, the ability to print money that the rest of the world had to accept, allowing America to fund wars and deficits without consequence. He was right. By 1971, the U.S. had a choice. Either restrict the money supply, raise interest rates, accept a recession, and defend the gold peg, or abandon gold entirely. On August 15, 1971, Richard Nixon appeared on television and announced that the United States would temporarily suspend the convertibility of dollars to gold. He called it temporary. It's been 53 years. When Nixon closed the gold window, most analysts expected chaos. For a few years there was. Currencies floated, inflation spiked, the dollar weakened. The system seemed to be unraveling. But then something unexpected happened. The dollar didn't collapse. It adapted. Because even without gold backing it, the world still needed dollars. The infrastructure was already there. Decades of contracts, debts, and reserves were denominated in dollars. Switching would have been impossibly expensive. But the U.S. needed something more, a new anchor, a reason for the world to keep demanding dollars even without the gold guarantee. They found it in oil. In 1974, after the oil crisis had sent shockwaves through the global economy, the United States made a deal with Saudi Arabia. The Saudis would price oil exclusively in dollars and invest their surplus revenues in U.S. Treasury bonds. In exchange, America would provide military protection and support. It wasn't a formal treaty, there was no signing ceremony, but the arrangement was real, and it changed everything. Because oil isn't optional. Every industrialized nation needs it, and if oil is priced in dollars, then every country needs a steady supply of dollars just to keep the lights on. Other OPEC nations followed Saudi Arabia's lead. Within a few years, the entire global oil market was denominated in dollars. The petrodollar system was born. And just like that, the dollar had a new anchor. Not gold, not even the size of the U.S. economy, but control over the commodity that powered modern civilization. This wasn't luck, it was strategy, and it worked better than gold ever did. Here's the part that breaks people's brains when they first learn it. The dollar's dominance today has almost nothing to do with how strong the U.S. economy is right now. It has everything to do with how embedded the dollar became in global systems. Think about it like this. Why does everyone use Windows even though better operating systems exist? Because everyone else uses Windows. Files are compatible, software is designed for it, switching costs are enormous. The dollar is the Windows of currencies. 60% of global foreign exchange reserves are held in dollars. 88% of foreign exchange transactions involve the dollar on one side. Half of all international payments, regardless of whether they involve the U.S., are settled in dollars. When a Japanese company buys auto parts from Germany, they often transact in dollars, not because either country is American, but because both have dollar reserves, dollar pricing systems, and dollar-denominated contracts. The dollar became what economists call the numeraire, the unit of account, the way we measure value across borders. And once that happened, displacing it became almost impossible. Because it's not just about trust in the U.S. government, it's about the fact that everyone else uses it, which makes you want to use it, which makes everyone else keep using it. It's a self-reinforcing loop.
Power gets strange.
The U.S. doesn't just benefit from this, it becomes responsible for it. Most people think dollar dominance is purely good for America, and in many ways, it is. The U.S. can borrow cheaply, it can run deficits that would destroy other countries, it can print money during crises without triggering hyperinflation. But there's a cost that's rarely discussed. Because the dollar is the global reserve currency, there's always excess demand for it. That keeps the dollar stronger than it would be otherwise. A strong dollar makes American exports expensive and imports cheap, which is great if you're a consumer buying a TV, but terrible if you're a factory worker competing with cheaper foreign goods. For decades, this dynamic hollowed out American manufacturing. The Rust Belt didn't decline because of bad policy alone. It declined partly because the dollar's role as a reserve currency made it harder for U.S. factories to compete. Economists call this the Triffin dilemma, named after the Belgian economist who predicted it in 1960. To supply the world with enough dollars, the U.S. has to run persistent trade deficits, sending dollars abroad. But persistent deficits eventually undermine confidence in the currency. It's a trap with no clean exit. The U.S. benefits from dollar dominance, but also bears the weight of it. And for the rest of the world, the effects are even more complicated. Developing countries that borrow in dollars are at the mercy of U.S. monetary policy. When the Federal Reserve raises interest rates to fight domestic inflation, it strengthens the dollar, making debt repayment harder for countries like Argentina, Turkey, or Pakistan. They didn't cause the problem, but they pay for it. In 2022 alone, more than a dozen countries faced currency crises, largely because the Fed tightened policy to cool the U.S. economy, which sent shockwaves through every dollar-denominated system on Earth. No one voted for that. No international body approved it. It just happened, because that's how the system works. So, if the dollar is this entrenched, can anything actually challenge it? For decades, the answer was no, but lately, the cracks are becoming visible. China has been quietly signing trade agreements that bypass the dollar entirely. Bilateral deals with Russia, Brazil, Saudi Arabia, oil sold in yuan, commodities priced in local currencies. After Russia invaded Ukraine in 2022, the U.S. and Europe froze hundreds of billions of dollars in Russian reserves. It was an effective sanction. But it also sent a message to every other country watching. Your dollar reserves aren't really yours. They can be frozen, seized, or cut off if the U.S. decides you've crossed a line. Suddenly, holding all your wealth in dollars feels less like safety and more like vulnerability. Even U.S. allies took notice. France and Germany have openly discussed reducing dependence on the dollar. The European Union has pushed for euro-denominated energy contracts. None of this will replace the dollar tomorrow, maybe not even in the next decade. But the momentum is shifting, and once countries start diversifying, even slowly, the network effect that made the dollar dominant starts working in reverse. Because the value of the dollar as a reserve currency isn't just about U.S. power, it's about everyone else believing that everyone else will keep using it. And belief, once it cracks, is very hard to repair. So how did the dollar take over the world? It happened in stages. A war that destroyed every other major economy, a conference that put the dollar at the center, a default that should have ended it but didn't, a deal with oil producers that gave it a new foundation, and a network effect so powerful that even when trust in America wavers, the system keeps running. But here's the uncomfortable truth. The dollar's dominance was never inevitable. It was a series of choices, accidents, and circumstances that happened to align. And what was built by circumstance can be undone by it. The question isn't whether the dollar will remain the world's reserve currency forever. Nothing does. The question is what comes next, and whether the transition, when it happens, will be smooth or catastrophic.